Okay, welcome everyone. I'm Brendan Walsh from Rocket Dollar. We have Mike here from Regiment and Matthew Metras. Mike, part of our partnership that we do with Regiment is trying to educate people on private marketing investing. This could be things like startups, real estate, an alternative asset, but a lot of crypto customers obviously have questions about a new asset. So part of this private marketing investing series is bringing in guests here to really bring in education. The Regiment brand name, spread that around of what they're doing. Mike can talk about that in a second, and really bring some good education talks that might not have been talked about today. We're going to cover a lot about crypto taxes today. Some of that might be on the taxable side, which, Rocket Dollar customers might not be your primary concern, but I constantly hear people asking about it on the phone anyway. I need to talk to someone that knows about crypto taxes. I don't get it. I have complex taxes. And then we're also going to go into some retirement rules about crypto today, what we know and what we don't know, and also a lot of the thorny questions that we constantly hear people ask on the phone. Sometimes I have a great answer for people. Sometimes I have to say, hey, we don't know. Luckily, there's been some answers bubbling up all over the space that are really exciting and kind of share what we know today and what we still don't know. So Mike, I'd love you to take it away and introduce Regiment.
Yeah, thank you, Brendan. And it's great to be here. Thanks everyone for attending. My name is Mike Cavanaugh. I'm with Regiment. We are a financial services ecosystem launched last March. We're located in Chicago, and we have been following the cryptocurrency both from an investment aspect and trading aspect for the better part of the last decade, for well over 5 years. Today truly was a demand-driven topic. We have been doing these educational events alongside a Rocket Dollar for the past year now. And, sometimes we come up with the ideas of what should we talk about? What should this month's guest be on our topic? But this month was demand driven. We started getting calls and emails from people asking us to get into more of the finer points and nuances of the taxation of cryptocurrencies. So today's guest, Matthew Metras from MDM Financial Services. We're just going to have a fireside chat, and I can really see this chat taking the direction from the audience's questions and dealing with their own personal situations. We're not going to give any specific tax advice today, but you're more than welcome to reach out to Matt after the seminar if there is anything specific to your situation. But Matt, why don't you give us a little background on your company, who you are, what you do, and we'll dive into some questions.
Sure. Thanks, Mike, and thanks, Brendan. Happy to be here today. It's obviously crypto taxes is an industry that didn't exist a few years ago, so it's a great time to be practicing in this space. My name is Matt Metras. I'm an enrolled agent and the owner of MDM Financial Services in Rochester, New York. I did my first crypto tax return in early 2015 for the 2014 tax year. And it wasn't a thing that really anyone was paying attention to then. And ever since sort of the 2017 bull run, my practice has been pretty much focused entirely on cryptocurrency, bookkeeping and reporting for taxation. I've been in practice tax-wise since 2003. And I do a lot in this space. And I also write for a couple tax sites. And I'm sure somewhere in the notes is my bio and stuff if you really want to get into the nitty gritty. But I'm really happy to be here. Thanks for the invite, guys.
Yeah, awesome. Thank you. Thanks for coming. So yeah, like you got into crypto from the taxation purposes from 2015. Maybe you can tell us about that first tax return, a little bit of the nitty gritty of what you remember, and then, we'll start diving into the different changes that you've noticed and how the space has grown. But what was getting into crypto taxation like? What were some of the issues you were solving for back then?
Sure. There was almost nothing that existed guidance-wise at that point. There was one document that came out in 2014 that had a few Q&As in an FAQ format, and that was it. So somehow I connected with this random person on Reddit, and they were looking for someone. They had been mostly Bitcoin and Dogecoin. They were in and out of those two, and they wanted to report all those trades. And I took payment for that return in Doge. So I was holding Doge from 2015, and I actually sold it in February because I never thought it was going to get higher than 9 cents, but I guess I was wrong on that one. So you can take tax advice from me, but don't take investing advice.
Yeah.
I'll miss that boat.
We already are starting to get some questions from the audience, but you know, some of the questions that we came up with before today's webinar, maybe you can give us some clarity, Matt, is you know, people wanting to know when and how often, I guess, you know, do you only pay tax when you sell your crypto to fiat, or anytime you make a trade, or both?
Yeah, so that's a something that there's still a lot of confusion out there about, and the IRS has been very specific that anytime you dispose of a property, whether you're trading it for fiat, whether you're trading it for another coin, sometimes even there's some gray area about even if you're putting it into a staking platform, if that's a disposition, you're realizing a capital gain or loss at that point, and you have a reportable transaction. There was some gray area around like-kind exchanges in the early days. Like-kind exchanges as a general option for taxation went away in 2018. So it's not really relevant anymore, but there are still people out there trying to take this like-kind position because they never filed their returns, or they're trying to catch up or amend previous returns. But the IRS has come out multiple times and said they are not really supportive of the like-kind treatment for cryptocurrency. So pretty much anytime you're turning a coin into another coin, that's going to be a taxable transaction that needs to be reported. The only other sort of gray area around that, and we don't have a great answer, is if I'm taking Bitcoin and I'm converting it to like wrapped Bitcoin on the Ethereum chain, or if I'm depositing something into like Aave or Compound and I'm getting an A coin or a C coin from it. We just don't know. The IRS hasn't specifically said one way or the other. If you want to be more conservative, it's likely that those are going to be taxable events once they finally rule on it. If you take a more aggressive position, and just an additional disclaimer, I know you already said it, none of this is financial advice, none of this is tax advice, none of this is legal advice. So consult your own professional before you do any of this. But you know, you could, if you're willing to fight it, take a more aggressive position on some of those coins and not treat them as a taxable gain or loss. But for the most part, pretty much everything is going to be a taxable event.
Have you seen, again, the disclaimer, this isn't tax advice. I'm just curious, have you seen any examples of people getting aggressive in the IRS enforcing, you know, against that aggression?
Not specifically. And part of that is because there's not a lot of transparency once things go into audit and appeals. You know, when we file a tax return, you're basically making a voluntary disclosure of what you're reporting as a gain or a loss. And then it goes into the depths of the IRS. And then we don't see or hear anything until something goes to tax court. But there's a lot of stages in between there. So if the IRS doesn't agree with a position that you took on your tax return, you know, they're going to take it to exam or audit. So you work with the auditor, you try to resolve your differences. If you can't come to an agreement, you can take that to appeals and make your case. An appeals department has a little bit more leeway in listening to your argument and not sort of just saying this is what the manual says and we have to rule it this way. If you aren't happy with how things turn out at appeals, that's when you have your option to take it to court. And there's different routes for court, but that's really where things get ultimately decided. And that's what sets precedent for future cases most of the time. Mm-hmm. So far, the IRS has been fairly hesitant to take things to court. We're not seeing a lot come that far through the pipeline because I don't think they want to set those precedents at this point, and then be bound by them. And they're not all, they can disagree with the court ruling too and say, well, we accept the ruling in this case, but we're not going to follow it for future cases. And then that gets muddy. But for the most part, they've tried to stay out of court when they can. Yeah.
And a good point in the queue in the chat here. Does the IRS clarify, when the IRS clarifies something, is this usually retroactive or required people to refile? So can you comment on that, Matt? And then I have a comment too.
So typically, when the IRS introduces guidance, it's typically not retroactive, but there's a big asterisk on that. And they can say, it's not that the guidance is retroactive, it's that the rules always were X, and you should have always treated it that way. So if you didn't, for example, the ruling on hard forks, there was a revenue ruling that came out in 2019 that was specific to how to treat coins that were received as a result of a hard fork. It almost really step by step outlined the Bitcoin Cash hard fork, which obviously had happened 2 years before that. But the expectation was, this is how you should have reported it. And if you didn't, you may want to consider amending.
Mm-hmm.
If in that situation, the taxpayer is not legally required to amend the return. If you file your return based on the best information to the best of your knowledge, and you sign that everything is accurate to the best of your knowledge, and then once that happens, there's no additional obligation to amend if you discover an error. But the benefit of amending is if you discover the error before the IRS does, you can get it fixed before you get hit with a lot of penalties.
Mm-hmm. And that's typically what we see in retirement law too, is, there's these prohibited transaction rules. They're very broad but helpful guidelines. The IRS will take someone to court, and there's a lot of landmark court cases in self-directed IRA law. So the really crafty self-directed investors will actually quote certain court cases. And what I tell the people on the phone is can I do this? Can I not do this? Is it going to be retroactive? It's like, Matt, we were talking about this earlier. Do you want to go to court over it? If there's a certain aggressive risk that you're taking in your IRA, you have to be prepared. If it's in a gray area or pushing some areas of the rules, you have to be willing to go to the court over it, argue that, and protect your investment.
Yeah, that's a great point. And it has to be enough of a dollar value that it's worth it, right? If you are sitting on a $5,000 crypto portfolio, it's not going to be worth the potential tax savings to hire somebody to represent you through audit, through appeals, through tax court. That's going to cost you thousands of dollars in and of itself, just in representation. Not to mention, if you lose, you still have to pay back all the tax with the penalties. So you really have to do a cost benefit analysis of whether it's worth it to be aggressive and sort of take those positions that may end up needing to be litigated. And if it's 100 grand in tax savings, then maybe it is worth it, right?
Yeah. Yeah, Matt, we had a question about wash sales coming in from Andrew. I think you kind of prepared something about wash sales.
Yeah, that's a great question. So in the Internal Revenue Code, when you're trading securities, there's a specific section provision around wash sales. And what a wash sale is when the simplified version is when you sell a security, like say I own Google stock and I'm going to sell that Google stock at a loss and then buy it back anytime in the next 30 days. If I were to do that, that's considered a wash loss, and the loss is disallowed. Because basically the IRS recognizes I never really wanted to sell that stock. I'm just doing it to realize the tax loss, and I'm buying back into that position at a lower basis. So as it stands right now, the wash loss rule does not apply to crypto. You can sell, you can buy back, you will never run afoul of the wash loss rule that way. However, there's this other provision, and it's called the economic substance doctrine. And that basically is sort of where the origins of the wash loss rule come from. And it says, if you're doing something specifically only for the tax purposes, it's going to be disallowed. You have to have some economic substance to the transaction. And what that typically means for the crypto market, it means you have to expose yourself to some kind of market risk. That can be, we have no idea how long that is, right? It's longer than like 5 seconds. On a day that the market's really volatile, 2 or 3 minutes might be enough to swing the market 5%. And that is a pretty substantial market risk, right? So it's really, the longer you wait to buy your position back, the safer you're going to be. But we know there's no specific time that exactly you have to wait. And again, comes down to that risk benefit analysis of how much tax savings you're realizing versus the risk of this becoming a problem later on. I typically advise people to wait a day or so if they can, just because the crypto market in general is so volatile. That would typically be a sufficient amount of time. But again, consult your own professional before engaging in that.
Yeah, that's fascinating. The wash sale kind of falls in line with the fact, that it's not a security, it's a currency. Some of the taxation rules don't fall in line, but at least that seems to make sense, that if you're looking at Bitcoin as a non-security, then not applying the wash rule to it would make a ton of sense.
It's important just to add, Mike, that when we say it's not a security, we're using the IRS definition, because the SEC, especially around some ICOs, has said these things are securities. You sold illegal securities, and that the SEC, the CBTC, the IRS, they all use different definitions, and we use the IRS definition when it comes to taxes.
Yes, no, that's a good point, Matt. Thank you for clarifying that, because there is some confusion out there with the different regulatory bodies, how each of them is viewing it. Almost feels like, you know, each of the organizations is making a land grab for revenue, but we'll let people make their judgments on their own about that. You know, we are getting some more questions, and, you know, it's something that I think is helpful to understand, the taxation around proof of stake rewards. You know, if there's guidance, you know, mining versus staking, you know, how are proof of stake rewards taxed?
Oh, man, that's a question and a half. So there's no official guidance around proof of stake. There is one of the very first things that the IRS issued guidance on was mining or proof of work block rewards. And they said proof of work rewards are income, ordinary income, at the fair market value of the currency at the time you receive it. And that was sort of it. That was all we got. Staking wasn't even really a thing then. Excuse me. We haven't even seen any crypto guidance really since 2019. And so here we are 2 years later. Obviously, the pandemic slowed things coming out of the IRS, and they're dealing with all their issues there. But the crypto market kept moving on. The crypto world kept moving on. So when it comes to proof of stake rewards, I mean, there's similarities, right, to proof of work. You're maintaining the blockchain. You're receiving coins or tokens as a result of that effort. And so some people feel that those should be analogous and you should treat staking the same way. The IRS may or may not rule that way if they ever put out guidance on it. I think it's fairly likely that that's the way that they're going to see it. And again, that would be the conservative position. If you claim that the rewards as income at the time you receive them, there's really nothing the IRS can come after you for. However, that can get really expensive, and it's burdensome, because obviously if you mine a block, you know when you got the rewards, and it's pretty easy. With staking, you're getting much smaller increments of rewards on a much more frequent basis. So trying to determine the value of those can be really, really problematic from a record keeping standpoint. A couple other things worth noting on that is there's a group of representatives in Congress that call themselves the Congressional Blockchain Caucus. They have issued a letter to the IRS requesting that the IRS not treat staking as income, but instead treat staking as a work product, created property. If you are a farmer and you have a lemon tree, you don't get taxed on the lemon when you pick it. You get taxed on the lemon when you sell it. If you're a painter and you're making paintings, you don't get taxed when your painting is done. You get taxed when you sell the painting. So that's sort of the analogy that they use. However, there's only, I think, 8 representatives in this group. And the irony is that Congress is the one who needs to change the law to make staking be taxed a specific way, but they don't have the leverage to get these things through Congress. They can't even really get them out of committee at this point.
Or an understanding of the basic technology.
Exactly. Yeah. So Congress, we're not holding that hope on. But so the other option is the courts, right? Because everything that we're looking at, we have to pigeonhole into an existing area of the tax code. There's nothing in the tax code about cryptocurrency. So we have to take things that already exist and sort of apply them to cryptocurrency. And there's this one section called Section 61, which basically just says everything is income, unless it's specifically not income. I mean, that's a little oversimplified, but that's sort of where the IRS gets the authority to tax this from. But if Congress isn't going to change the law, then we turn to the courts and try to have the court interpret the way the law currently exists. So there is a lawsuit just filed in the last couple of weeks by a couple named the Jarretts, and they're suing the federal government over tax that they paid on Tezos staking. They make all the same arguments that the Congressional Blockchain Caucus does, et cetera. So it'll be very interesting to see how that plays out, because that could change the landscape around staking taxation.
Great.
That's a great answer. I just want to, this is more out of my curiosity. So like going to mining, like in a proof of work, like Bitcoin, if I'm if I'm running a couple rigs and, you know, I get some rewards, do I get to offset my capital expenditures, like what it costs me to, you know, purchase the rig and pay for the electricity? Or am I getting taxed without any regard to the cost that I'm putting in to help support the blockchain that runs Bitcoin?
That's a great question. And the answer is it depends. We joked before everybody came in that the answer to everything is it depends. So whether or not you can deduct the expenses depends on whether or not your activity is a business or a hobby. And the IRS has no bright line test for whether something is a business or a hobby. They have a 9-factor sort of matrix that they use when they're auditing to sort of determine if something meets the threshold of being a business. Basically, the quick and dirty answer is if you're doing it for profit and you're doing it with regularity, it should be a business. It's a little bit more nuanced than that. And they have these, you know, do you keep books and records? Have you made a profit in past years? Have you ever been successful in this industry in the past? Do you consult with people who know more than you? There's all these things that they look at. But in general, if you're a business, you can deduct any ordinary and necessary business expenses. So that would be your mining rigs, some of your internet connection, obviously your electricity. There's going to be a lot of that if you're mining at home, and that sort of thing. And if you are not, if you're in a hobby situation, then it's sort of the worst case scenario because you are getting taxed on the gross income before you take any deductions. And prior to the Tax Cuts and Jobs Act of 2018, you could write those expenses off in a different place on your tax return. But part of that tax bill, it got rid of hobby expenses. So now if you're a hobbyist, you're basically out of luck. So you want to work really hard to make sure you're meeting that business threshold, because a lot of miners don't even make any money when you get to the end of the day and you think about how much you know, the cards are costing and how much the electricity is costing and all that. They break even at best. So definitely want to make sure you're going to meet the criteria of being a business on that.
Yeah, or find some new hobbies, right?
Exactly.
Brendan, there's quite a few questions in the chat. And Matt, feel free to chime in as well, but there's a couple questions about self-directed IRAs and taxation. Maybe you can clean up a few of those questions just because it's topical to what Rocket Dollar does.
Yeah, so I mean, the #1 question of 2020. I mean, the phone, like every single day, can I stake an IRA? Can I stake an IRA? Can I stake an IRA? Get off the conversation and have to answer another conversation again and again. And the answer is, you know, there's nothing that says you can't with your IRA. There's no guidance out there that says, hey, that you can't use this asset, go lend it out, and then, you know, receive those rewards for it. A few things to keep in mind, though. Like Matt was saying, we have to look to older laws to kind of inform us what we can and can't do. With staking, you know, you can have a house in your IRA, you can rent that out, you can get rent. So why can't you get a reward for staking or other assets? So you should not get margin in an IRA. It's very, very popular to go stake your crypto. Maybe you get some type of interest rate, but you also get loans. Very popular with crypto investors to gather those loans, use those for other things. You should never really be doing it in an IRA because there's a tax called UBIT and UDFI. And it was created so it was really hard. The government was frustrated that people were hiding businesses that they think should have been taxable in either charities or retirement accounts. So this UBIT tax is a way to, you know, for the government to kick out a few people and say, hey, this activity, we think it should be taxable. So you really cannot get extensions of credit in an IRA. You also cannot take money from your IRA and pocket it. So a common question is, I stake all this crypto. I stake $10,000, $15,000 of crypto in my IRA. Now I'm going to pocket the loan. You really can't have those situations of your personal crypto or finances and your retirement crypto ever cross over. So I think one of the staking services, even if you more you stake, you get something like a Netflix subscription. Should never, ever, ever take like something like that and use it because of your IRA. This is called, so I just talked about UBIT. That's the tax that can be very complex, but on margin and taking out loans. And then self-dealing is when you take a reward or something personally from that staking and you use it in your personal life. So if you're doing staking, you should be doing it just for your IRA, and you should just be looking for that interest rate. You should not be looking for physical or kind of real life rewards. You should not be looking for loans. All of those are just going to immensely complicate your situation and potentially cause you a prohibited transaction in the future. We did talk about mining, and Matt just gave us a great difference. There's personal hobbyist mining. There is more passive, or like you just pay someone else to mine for you. In a retirement account, with that self-dealing, not having your personal situation and your IRA crossover, someone's like, I bought a computer with my IRA, but whose power bill is it sitting on? Where is that computer sitting? Is it sitting in your home? The amount of work that you'd need to do to separate yourself from a mining rig that's near your home or around it is very extreme, and often, not really worth it. So, there are some crypto miners out there that are talking to crypto investors, seeing, if they can get investments from self-directed IRAs, but they are setting up specifically passive entities. And a lot of people are used to holding their crypto closely, very, very closely. And that's part of why people like the asset. So that just obviously, hits a lot of different areas in retirement accounts that the IRS is not always exactly okay with or happy with. And we can get into those later on in the webinar.
Yeah, I think oh, sorry, go ahead, Mike.
No, go ahead, Matt, please.
The biggest takeaway is you don't want to be too aggressive or too creative inside your IRA. And there's a lot of opportunities, especially now with the advent of DeFi, to get yourself in trouble in this area. And I've seen it happen to people who had a prohibited transaction, blew their IRA election, and had the whole thing deemed a distribution. And that's messy to clean up. You don't want to find yourself in that situation. I saw another question in here about, with a self-directed IRA, can you buy and sell inside the IRA without taxable event occurring? Yes, that's sort of the basic idea, the reason behind setting it up.
Yeah, and that really, so we have some investors that are holders that just are thinking about the long-term tax benefit when they sell those dollars. We have other customers that are very, very heavy traders that are trading super, super often, and I really just appreciate, not having that capital gain hit them with every trade that they're making.
Yeah, there's a huge opportunity to push these taxes off inside the IRA, and that's the same idea when you have any sort of tax-deferred vehicle. Whether it's an IRA or 401k or any retirement plan you have at work, you're making all these gains and not paying taxes on them at your current high income. And the idea is that when you're in retirement, if it's a traditional IRA, you're going to have less income, so your tax bracket's going to be lower, and you're going to pay fewer taxes at the time you dispose of the assets, instead of now when you're earning and potentially in a higher bracket.
Good points. Thanks for addressing a couple of those questions as well. And just a housekeeping to all the attendees. We are recording this, so we will send out a follow-up email to all the attendees with the recording. And then if we don't get to one of your questions, we'll type in our email addresses in the chat, so you can reach out to us individually if we didn't get the time to answer your question specifically. I'm just going to keep moving along. In our pre-call, we were talking about another area of taxation, and that's on liquidity pools. Matt, how does someone calculate taxes on liquidity pools?
Yeah, man, that's another mess.
Keep bringing the messy ones in.
Yeah, exactly. So again, the big caveat is the liquidity pool is not anywhere on the IRS's radar. All the DeFi stuff, yield farming, everything that we're looking at, it's going to be years before we get guidance on that stuff, because they're just now, and by just now I mean 2 years ago, covering hard forks. And there's a huge lag there. So when it comes to a liquidity pool, you have to basically break it down to its component transactions. And it may differ depending on the platform that you're farming on. So if you go into a pool, let's say, for example, I put 1 Ethereum and 2,000 USDC into a pool, and I don't get any sort of like staking coin or anything in return, that's probably not a capital transaction. However, when I pull my coins out of the pool at some later date, I'm going to have a different ratio of coins versus when they went in. So let's, for easy math, let's say I put 1 Ethereum and 2,000 USDC in, and I get 0.8 Ethereum and 2,200 USDC back out. That we're going to basically consider that a capital transaction where you're selling 0.2 Ethereum and getting 200 US dollar coin in return. So in theory, you're going to typically have a loss when you pull out of a capital loss out of the liquidity pool, because that's how it's designed. You're supposed to make up that loss in the fees that you get as a result of providing that liquidity. So the fees are going to be ordinary income at the time you receive them. They're going to go on a different part of your tax return. They go on a place called Schedule 1 versus any sort of capital transaction goes on Schedule D. So you have 2 different taxable things going on. You may have a gain or ordinary income on the fee side, and you may have a loss on the asset side, on the capital side, as you pull those coins back out of the liquidity pool. If you're on a different platform where you put your coins in and you get some sort of other token that represents your stake in the pool, that could be a capital transaction, and probably is. We don't know. Again, it comes back to how aggressive and conservative you want to be. Your mileage may vary. Obviously, consult with someone about your specific situation. But there's a lot of unanswered questions, and it may be a long time before we have official answers to them.
Yeah, we had someone in the chat comment, hey, it'd be helpful to have like a crypto 101 introduction. And Regiment and Rocket Dollar, we did two great webinars before. We had a kind of slideshow education and also a fireside chat, because really to help people learn about this topic. This one is definitely for some of our hardcore crypto customers. And just to let you know what's happening is we have some people doing crypto for the first time. We have a lot of people trying to do a lot of adventurous things with crypto that, they've been a very experienced crypto people for a long time, and they're running into this really tough to answer IRS questions. So this is definitely the, the 204 class or the 301, but feel free to go back to our other webinars if this one's a bit overwhelming. And we're going to get into a lot of the retirement FAQs here the second half. Matt's given us some great help on some of those what's taxable and what's not taxable.
Yeah, and the guidance as well is helpful. Yeah, but jumping onto the IRA side, it seemed, Brendan, back in the early 2000s, before crypto existed, people purchased gold bars, and it had at-home safes, and they were buying it with their self-directed IRAs, and then putting the gold physically in their home safes. Do you have any insight as to why this didn't last, and how can we try to tie current crypto as to digital gold to rules for other assets?
Yeah, thank you, Mike. This was a big thing back in the early 2000s. You might still see ads for gold in an IRA, gold in an IRA. If your uncle or dad was maybe doing this stuff before you, a lot of people found a great benefit of, they like to hold an asset closely, just like crypto investors do. They would take it, throw it in the home safe. And the IRS was going and auditing some of these IRA investors with precious metals, and they were getting frustrated. They would go and open the home safe, and the person had maybe reported 5 bars, were bought or sold on their taxes. They expected, maybe 5 bars to be there when they opened the safe. Well, it wasn't always the case. When they opened the safe, maybe there was 3 bars or there was 8 bars of gold. So a lot of these investors would be caught in the IRS enforcement going, where'd they come from? These other, these 3 other bars that make 8, these 3 are my personal bars. These 5 are my IRAs. Then the IRS agent would go, which one is which? And the investor wouldn't be able to answer. And so, the IRS agents started to get pretty frustrated about this. And this is something that actually, went to what the process Matt is talking to. People are getting taken to court, through appeals process. And the IRS basically made a ruling and said, hey, you cannot store gold in a home safe anymore. You have to keep it with a qualified trust or custodian for basically 2 reasons. One, they just wanted to be less funny business with people messing around with that gold and precious metals. Is 2, that there's a qualified trust or custodian that could verify the transaction. If the investor there's suspicion the investor wasn't being truthful about it. So pushing that back a little bit more to the organization kept the IRS saying, okay, we can trust the custodian to realize a check on the power of the investor does something a little off the wall or crazy, and also verify, hey, they bought these 5 bars of gold then, they sold them then. So we have tons and tons of questions. I've already seen a bunch of them today. Can I use a hardware wallet? 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 We have never got an answer from the IRS. Can you use a hardware wallet or not? There's nothing saying you can't use one right now. What I just want to make clear to people is that the IRS has often been frustrated or not okay with people that have assets in their home. They don't like people being able to hide, obscure the value, to mess with the asset, to do something that basically they can mess with something, the value disappears, or is then seen as non-taxable because it's gone or pushed off somewhere else. So a lot of crypto people will push right back and say, there's the blockchain. There is. But, I think, Matt, we were talking about this, like, what if someone says like, oh, I lost my wallet, it's gone. Did you really lose it? Is it in someone else's hands now? Rocket Dollar, it sounds a little ludicrous, but we recommend if you're using a hardware wallet, is it best to store it in the home? If you're a holder, can you store it in a safety deposit box down the street? It sounds a bit ludicrous to a lot of investors. There is no rule saying you can't put a storage device in your own home. However, what Matt was saying, this is all about reducing risk. We don't know how the IRS is going to treat hardware wallets. We don't know if, are they going to say, hey, this is fine, you can all have hardware wallets and treasures, or are they going to come down on some investors and say, hey, these investors were improperly using their hardware wallets to obscure or mess with their crypto in ways that we don't like. So we're going to take them to court over it. You never want that to be happening with your IRA, and you never want a big balance of your IRA potentially distributed for something like that. So, we've encouraged customers to, go to exchange security you respect. There's multi-sig now, which is more digital in nature. Wherever you move the crypto, it really has to be clear it's your IRA's crypto. And obviously with blockchain records, some people feel, hey, that's really easy to verify. I don't see any issues. I can quickly prove that without any issues with the IRS. However, some people ask us about a lot of different transactions. You can reach a lot of complications with that. So the long and short story answer is, someone say, well, I'm afraid of hackers. Well, are you afraid of the IRS enforcement as well? You just have to keep that and weigh the options for your IRA. Is this really worth it for the security risk to put it in a storage device if some of the taxation is unclear? So a lot of people, they've asked, like, we said, hey, Rocket Dollar, we need a definitive answer on this. Can you please put on your website a more clear answer on this? There's really not an answer. So a lot of people ask me and I say, hey, I want you to educate you on the risks. I want to educate what you know. I want to educate what we really don't know. As Matt's saying, this could be a couple years, might be 3, 4, 5, 6 years more before we learn, can you keep crypto in a hardware wallet on an IRA? And when I tell people that, a lot of people will say, hey, because of the risk, I'm going to weigh the risk. That makes the decision really clear to them.
Yeah, just to add, it is going to be a couple of years, and that I just recently worked with a client who had a prohibited transaction and bought coins with his LLC, sent them to a personal wallet. The custodian determined that that was a distribution event, retroactive to 2017. So we had to go back and amend his 2017 taxes this year, pay all the interest and penalties on the distribution of his entire IRA, which was really, really ugly as far as a penalties and interest standpoint. Also, just to add, if you end up in a court situation, the burden of proof is not on the IRS to prove you did something wrong. It's the burden of proof is on the taxpayer to prove that you did it all right. And that, it seems like, pretty simple thing to disregard, but you have to have the records. And with that said, I saw a question in the chat earlier about using something like CoinJoin, and any kind of joining service or Tumblr, especially in an IRA, but just in general, you want to stay away from that stuff unless you have a really legitimate reason to be doing that privacy wise. But that's immediately going to lose any credibility you have in an IRS situation if you're using anything to obscure your paper trail. And that includes privacy coins, it includes tumbling services, all that kind of stuff that, you know, some say is the philosophical idea behind crypto. The IRS is not going to buy into that. And that's going to make for a real bad day for you if that comes down to an audit situation.
Yeah, a lot of those privacy coins, if you erase your blockchain record or you obscure that in any way, that's really the only lifeline you have left. If your crypto is far away from a custodian, how is the custodian supposed to help you prove that? They really don't have any records, so they can't help you verify. If the blockchain record is obscured or a privacy coin, that's obscured as well. And also, some people say, oh, I keep great track of my crypto. And then they talk to me about something about 25 different transactions to get to a certain area that they want to get to. You really don't want to have to be under audit and have a breadcrumb trail 25, 30 transactions long just to make sense of something. You should really be keeping things simple inside of your IRA. Keep them straightforward. Again, what Matt said, maybe not the area to take a risk. Go for the risk in your taxable account. Crypto is a very amazing asset. There's these two forces and pushes and pulls. Crypto wants a lot of privacy and to move away from the established financial system. And then the IRS, whenever they tax something, especially in an IRA, because IRAs have this special tax status, they want things to be very open, easy to see, clearly credited to your IRA, LLC, and bank account. And you can get into DeFi in a little bit. I have some stuff I can share about that.
Yeah, we'll touch on DeFi in a second. You hinted at this earlier, and Matt kind of just brought it up again, but maybe we could get a little clarity on, what is arguably one of the biggest retirement prohibited transactions. Brendan, maybe you can speak to that in self-dealing, and then Matt, maybe you can touch on some of the tax implications, and like when someone would sell crypto from their personal account to their retirement account. Why is this such a big issue? It seems like this was a point mentioned twice, and it's some of my like hot topic questions here. So why is self-dealing such a big issue?
Well, first, I think it's just a lack of knowledge. A lot of what crypto is makes it very easy to move stuff between wallet to wallet, move things around, get it into different wallets. And a lot of people think of crypto as a way to pay. So a lot of people ask, hey, can I contribute crypto to an IRA? Crypto is really seen as property. So the only contribution the IRS will accept going directly into the IRA is fiat dollars. Once you're in crypto in an IRA, you could, obviously go into different cryptos, transact in different cryptos because you're transacting that property in a tax shielded account. But doing an actual contribution, you cannot do that. So a lot of people want to say, hey, I want to contribute $6,000 of Bitcoin into my IRA. Currently, I don't know if there's a company or custodian that allow you to do that. I really don't think there is. As far as moving crypto from one IRA to another, there's not a lot of custodians. I've seen like one or two of our competitors say, hey, you can transfer crypto from Bitcoin IRA to us. Honestly, a lot of custodians in the retirement side are really old school. Their technology is not the greatest. Rocket Dollar's been trying to help that with that technology and bring that up to speed. But you don't really want an old retirement custodian that's used to dealing with precious metals handling your crypto keys very closely. So the best is when you're contributing to an IRA or you're doing a transfer and rollover to come over in fiat. Then you're entering crypto through the IRA LLC, and that's where you're doing all your crypto transactions. You're keeping that very sectioned off, just your retirement crypto. New accounts registered in the IRA LLC, clearly delineated for the IRA LLC. The exchanges will register an IRA LLC and show, hey, this crypto is from the IRA. If you shovel stuff off into the same wallet or cold storage device, maybe the IRS can follow your bread trail, but how do they prove that your Coinbase IRA LLC account is different? It's because Coinbase or Gemini our partnership, they'll put that on the LLC titling to make sure it's very clear this is coming from an IRA LLC, not a personal account.
Just to build on that, and to answer Mike's question, the reason this is such a big deal is that there's the potential for fraud. And anytime there's a potential for fraud, the IRS wants to shut it down. And back to Brendan's gold bar analogy, if I have 8 gold bars in my safe and 5 of them are in the IRA, and I'm kind of sketchy on which ones are which, and they don't all weigh the same amount, there's the ability to manipulate what I own and what the IRA owns in order to maximize my profit and lower my tax. And the IRS is not interested in that at all. They don't want anything to do with that. Any sort of scheme, people call me all the time and they're like, I've come up with this crazy scheme that I think is going to make me, so I never have to pay tax again for the rest of my life. The IRS has already thought of it. And they've set up safeguards to prevent that from happening. So that's really what it's about, just keeping things completely separate and making sure you don't commingle is the easiest way to stay out of trouble.
Great, thank you guys. It's very helpful. And I know we're still getting questions from the crowd. I just had one more topic that we kind of thought would be good to cover before, and then we'll jump to some of these questions. And again, just a reminder to our audience that if you have any individual questions that don't get answered here today, Matt and Brendan, myself will all type our email addresses in the chat so you can copy it and shoot individual questions over. So DeFi has grown immensely in the last 2 years, just explosion of growth. What are some potential pitfalls within the IRA world and the non-IRA world as far as DeFi goes and its taxation?
Yeah, so the biggest one that we get from customers is that, when you're using one of our partners, we have a partner with, you'll see a partnership with Gemini up there, River Financial, ErisX. Some of our customers use Coinbase, and people always ask us about other exchanges or DeFi, is that all of those exchanges know how to take an LLC and they know how to take a W-9 that says, hey, that LLC is a disregarded entity. So, activity in here is it's very clear if someone were to look at it, that that's activity from an IRA. Once you start getting off the exchanges, the burden of proof really starts falling much more intensely on you to prove that this is, IRA activity. So a lot of that, a lot of DeFi won't take something, won't take into account an LLC titling. They'll take very little information, maybe something like an email or a wallet address. And, again, crypto people push back and say, hey, there's a blockchain record. I went from this wallet to this wallet. That is true. If you're keeping amazing records and it's just one digital wallet, but some custodians are not friendly to that. Some custodians don't want to deal with that. I just saw a company recently. I'll let you know, I haven't used them, but I want to approach them. This is the first one I've seen. I just put them in the chat that actually attaches an LLC to a wallet. I've been searching for a company like this for a long time, because with DeFi, when you go off to these private wallets, you can title it in MetaMask, or you can title it in some of these tracking services, but it's just a title. It's not a verified know your customer process and KYC. There's no custodian to back you up. There's no other party proving, hey, all of these transactions attributed this LLC right here in this titling. So that's, a lot of people ask about DeFi. Again, nothing saying you can't do DeFi. If you're using a digital wallet, you're being safe and very low risk about it. But once you go, once you start venturing further and further away from the centralized exchanges, you lose all of that titling and all that custodian extra protection to, pop up the W-9 and said, hey, these transactions are from an IRA.
Yeah, and I think you covered that great, Brendan. It's really on you to prove that you did it the right way. And there's a whole list of prohibited transactions you're not allowed to deal with. There's a specific provision in the code, section 408, that says you can't invest in collectibles in an IRA. Mm-hmm. And then it gives examples. And so not necessarily DeFi related, but NFTs have been really, really popular this year. The question becomes, is NFT considered a work of art? Because you can't hold work of art in your IRA. And my gut would be, I wouldn't hold an NFT in there either. No. And there's lots of specifics around not being able to hold metal, gems, stamps, coins. A lot of things are really close to what we deal with in the crypto space, but they're not specifically outlawed. They're not specifically allowed. And so some of these can come down to how they get interpreted by the service. or by your individual auditor, may take a different position, and you're going to have to fight it even more. So I sound like a broken record, if anybody's old enough to understand that reference in the crypto space, but Mike gets me. Keep it simple. The more complicated you get in your IRA, the more potential you have to have problems down the road.
Yeah, and a lot of the major centralized exchanges, and I know there's like just a bias from the community, that the whole community loves decentralization. They love moving away. But what do you really want? Maybe it's you're using DeFi to try and get staking. Celsius Network now has an institutional sign up. BlockFi has an institutional sign up. It takes a while to get approved. They've been very busy, but you get approved, and it's clearly saying this staking, this reward is clearly credited to my IRA. And, like we've talked a little bit with Aave and, some of these other decentralized, we have some partners that give lots of support and, can help provide records. Some of them that really just can't. And a lot of it's just a service issue. There's a lot of unknown questions, and a lot of people have questions. They want to use a decentralized service. We're not going to have all the answers. And there's really no one you can call if you have an issue. And with an IRA, sometimes there's that extra little bit of support is very, very helpful. Like we started a partnership with ErisX and River Financial, simply because they're much easier to contact, than some of the other big exchanges. You can get on there. You can call someone if you need to. They have more limited coins, obviously, so that's not going to be as wide. We're also educating them on the IRA LLC, what it does, what capabilities it has and does not have. So, educating them, saying, hey, moving something from ErisX to DeFi versus ErisX to Celsius Network, clearly delineated in your LLC, that's a much less risky proposition to go in that direction. So if you're just looking for a particular service, Gemini's adding Gemini Earn now. BlockFi and Celsius exist and now have good corporate onboardings. Look and see if you can replicate that DeFi a little bit more centralized for your IRA, then go very far from the DeFi path in your taxable side. That's where you can take a bit more risks.
Great, thank you guys. There's about 12 questions in the chat, and I don't think we're going to have time to get to all the questions. Could you guys both just type your emails into the chat, and then I'm going to ask the people that still have unanswered questions to just send you guys emails separately, if that's okay. We'll also follow up with the recording as well as a thank you note for coming to today. I'm just going to ask Matt and Brendan, could you guys just leave us with a nugget of information that we haven't talked about? Like maybe it's a resource. I saw some people asking some like resource type questions about how to fill out a W-9 or like different nuances about withdrawals from IRAs. Maybe there's something you can share that we haven't talked about that you feel is a good free nugget of information that we can leave the listeners with today, because we're not going to have time to get to all the questions. Sure. I'll start with you, Brendan. Go ahead.
Yeah, so leaving here today, and there's one major, very good question that was just answered in the chat, saying something about BlockFi and Celsius not accepting W-9s. We have been in the forefront at Rocket Dollar trying to push people to understand the IRA side, to understand the taxable side. Having the LLC clearly registered, that is way better than nothing. That is way, way, way better than having nothing registered at all. Some crypto services only take an email. What we've been trying out there is a push on companies that don't take W-9s, that don't have a corporate onboarding, saying, look, there's a lot of demand to do crypto in an IRA LLC. There's a lot of demand to make sure the taxes are done right. So rest assured, we're working on it. Just know some of these companies have been so busy over the last year and a half. I've talked to some of them personally multiple times. They're struggling even answering the phone right now. So they're staffing up. They're trying to search for these answers just as you are. So rest assured, we're trying to find the answers. We're prodding crypto lawyers to say, hey, please push opinion letters on this. Try and get search answers for this. And also just try and be an advocate for the space. Because as you guys want to do this in IRA, we're trying to push the partners to get answers and get more used to of all of your guys' needs.
Perfect. Matt?
Awesome. Yeah. And I threw my email in the chat. Just let me know that you were on this webinar if you do email me, just because I get a lot of random questions and I want to make sure that people here get their questions answered.
Okay.
I have a couple mini nuggets. How about that?
Good.
Everything that's known about crypto taxation is on the IRS website. It's not a lot, but if you search IRS crypto FAQ, you're going to get a list of about 40 some questions. That's pretty much everything that is firm and we know. Everything else is going to be more nuanced. It's going to be an it depends kind of answer. Make sure that you are keeping, two more, make sure you're keeping really good records. If you ever are in question about whether or not you should keep a record of something, keep it. The biggest thing that I see in my practice and that ends up costing people money to pay people like me to fix their problems is that they didn't keep great records. And they have holes. They forgot about the 7 Bitcoin they gave to their brother. They forgot about when they bought on this one exchange this one time to get this one coin. When we start reconciling everything, we see the holes. We see, okay, well, you bought, Ethereum, but you didn't have enough Ethereum, or you didn't have whatever you bought it with, there's holes, and we have to plug the holes, and that's what's time consuming. So keep records. That'll save you money in the long term. Last thing, reach out to your elected representatives. They are the ones who ultimately make the laws around this, and they need to know that this is something that their constituents care about. When you look at the makeup of Congress, they are not on the Venn diagram of Congress and people into crypto, there's not a lot of overlap there. So they need to know that their constituents care about this, want to see the laws put in place that are beneficial to the crypto community. And you'd be surprised how much just emailing your congressperson or your senator can influence the process.
Yeah, and
That's awesome.
a lot of our customers even have informed us of partners. I've had our customers educate me on various, crypto technology comes at us so fast. I just have our customers talk at me, say, hey, explain to me what you're trying to do. And I want to thank the customers have been really helpful. They've also pointed me to some of the partners that a lot of Rocket Dollar customers work with today. And, we're constantly trying to push them and continue to educate people on the space.
That's awesome. Thank you guys so much for your time today, Matt, Brendan, and everybody in attendance. And thanks for offering up your emails to respond to the people that came here today. And have a great day, rest of your day, everybody. Matt, Brendan, thank you again.
All right,
Thanks, Mike.
thank you.
Thanks, Brendan.
Yep. Have a good one.